Okay, welcome to Salty Investors, episode number 2. I'm Scott and
I'm Tim.
Tim, it is September the 23rd, Friday, September the 23rd. A day and a half ago, because it was in the US, the Federal Reserve decided to hike rates by 75 basis points again, taking the Fed funds rate up to a range of 3 to 3.25. The market, fair to say, shit itself a little bit because it keeps trying to front run the pivot. They think the Fed's going to blink. I think that's what they think, but it's not coming. It looks like, and Powell says more rate rises to come. I think Goldman Sachs came out and said they expect it to sort of end around 4.5 to 5 now. So what does this mean? What does this all mean, Tim? What do you think? Should we pay any attention? Do we care?
Oh, like it's definitely going to hurt a few people. Like if you're on car loans or reset mortgages, you'd be panicking a little bit now.
Yeah.
I think, especially if that 4.5 number. I'd be a bit worried. I don't know where it's going. The
thing that differentiates America's housing market to ours is most people are on 30-year fixed over there. So great news. So for a lot of people over in the United States who own houses, doesn't mean anything. They're on 30-year fixed anyway. They locked in 2.5 or 3%, and they feel fine. Yeah. But I did see the guy from Calculated Risk who runs a housing blog, Bill McBride. He put out that I think the variable mortgage rate's up to 6.6, which is the highest in 15 years.
Wow. And
it's only got to go another 0.2 and it'll be the highest in 20 years. So, but it's still 6.6% on a mortgage is historically not that high. But it does mean, how much you can borrow is a lot less, and house prices have to adjust. But of course, if you're locked in at 3%, and you're happy with where you live, you don't need to move. Well, you're not going to reduce your house price and get rid of it, are you? You're just going to sit on it.
Yeah, it's a long-term asset. So
it just makes it tough.
Stay there for 5 to 10 years, you'll be fine.
Yeah. Let's read a couple of I picked out a couple of quotes from, because I thought maybe they were newsworthy. Reducing inflation will likely require a sustained period of below-trend growth and will very likely require a softening of labour conditions. So he's telling you unemployment rate's going to go up, and below-trend growth, well, how far below? Could be a recession. The chances of that keep going up the further they raise rates. We will keep at it until we are confident the job is done. So he thinks he is the reincarnation of Paul Volcker, I think. He's not going to blink. He's going to go the whole hog.
So there's that 75 next time? 75 next? Is that 75 next time, you reckon?
Yeah, well, don't know. Some are saying, because remember the Fed doesn't meet every month, they meet every 6 or 8 weeks. So I think they've probably got 2 meetings before Christmas.
Mm-hmm.
So I guess they can, if they go 75, they're going to get, it's going to be 4.5, 4.75. Who knows? I think I saw economists penciling in like 50 basis points next couple, but we'll see.
That'll be a signal to the market that the pivot's on. That'll be a signal that the pivot's on, or they're going to hold at that level, which is then going to fire up inflation. So he's like, his words there, like he's going to take it on. He's not going to be a pussy about it, and he's actually going to fight it. But is it just talk or?
Well, the thing is, if you're looking for a pivot as well, people should remember that in the financial crisis, I'm not saying we're going to have a financial crisis this time, but the Fed cut and cut and cut. They were cutting rates and the market was still going down, right? They cut right through. The bear market started officially, I think, in about November or it might have been October 2007, didn't finish till March 2009. The Fed cut all the way through that, and it didn't turn around. I was just I went back to have a look at the .com, because that was mean, that wasn't a financial crisis. That was an equity bubble. There wasn't much in the way of debt. Some people margined themselves like idiots. That always happens. But it wasn't a debt bubble. It was an equity bubble. That S&P peaked March of 2000, didn't bottom until 2002, and almost nearly revisited it in 2003. I mean, the market basically went sideways for another year. So it took almost three. I mean, it did bottom October 2002, and then March 2003 it sort of gets close to that bottom again. So things can go sideways for a long time, and I don't know. People keep thinking get the bottom and she's up and away again. I don't know. Maybe we're in for a bit of sideways action for a while. It's going to be tough conditions.
But when you do inflation adjusted returns, total market returns, but inflation adjusted, you can go for a decade sideways, easy. So, but people haven't factored that in, I think, and it will be interesting to see.
Or more, because 66 to 82. Basically, the stock market went nowhere. Multiples were compressed. Not again. We're not saying that's going to happen again, but markets can be shitty for a while. Now you kindly posted this chart. What are we looking at here?
Well, like everyone's complaining and whinging and moaning about the rates. They're going up. How much is going to squeeze them? But you've got to compare it to the CPI. Like the Fed's not just doing this to be, to hurt people. Like I see, Elizabeth Warren complaining. The Fed's trying to kill jobs and all these sort of people.
Pocahontas.
Yeah. But like there's good reasons why the Fed has to hike. And if you look at the real central interest rate, it looks quite nasty still all over the world. There's only a couple of places that are decent, and you look at them like China, like everyone's complaining about China's burning to the ground, and it's 1.2% real rate. You look at Eurozone, it's negative 8.4. Like, how can people on fixed incomes and the poor, who haven't got huge amount of assets, live in a world that they're getting negative 8.4%? Like, this is horrendous. So we're not some basket case, like Venezuela or something. So the fake Fed should be hiking in Australia.
Argentina.
What do they got?
Yeah. Well, how's Argentina's? They're almost at parity, aren't they? I mean, they've got a 75% benchmark rate and 78.5% inflation.
Well, at least they're being a little bit honest there,
proactive. They're being proactive. Yeah. Brazil's really trying to crush inflation, aren't they? I mean, they're going all out. 13.75 to 8.7. Turkey, what are they doing? They're a bit laggard.
Yeah, and there's a couple Mexico, it's basket case central. It's basically parity, negative 0.2, and then you look at us, Australia, and we're negative 3.8, so we still haven't hiked enough, I know the neutral rate you don't have to go as high as inflation to get to the neutral rate. It's sort of auto balance out here a little bit, but obviously there's a fair bit of room here to hike. That's all I'm trying to...
We're at 2.85, aren't we? I think are we at 2.85 now? Well, it wasn't the last... I thought we were at 2.85 by now. No.
Oh,
yes.
2.8.
Sure we are.
Okay. So we're
keep up.
We're pretty easy with... We have the US, we're pretty parity with there.
Yeah, but still... Yeah.
Back to my argument, we don't really need the RBA, we can just follow the Fed. But yes...
Yeah, well, you know the Taylor rule, don't you? Which is I think inflation plus 2%, something. That's what the Fed funds rate should be. Like John Taylor, economist, he just basically said, whatever the inflation rate is, add 2%, and that should be your Fed funds rate. Done. You don't need a Federal Reserve. That's it. I don't know.
Okay.
Not an expert in that one, but. So I thought, because markets are trying to front run when the Fed pivot is trying to look through the doom and gloom, which markets try to do. I thought this was worth playing because of what Niall Ferguson, for those that don't know, is a financial historian and written some really good books. Ascent of Money was one that I read a while ago. But it's interesting what he had to say, and I don't know what this shebang was. This wasn't Jackson Hole or something, was it? But it was fairly recent.
In Europe somewhere.
It's a couple of weeks ago, I think.
Well, yes, Steve. This time last year, we were sitting here, and I said, having listened to Professor Stiglitz say there was no inflation problem, that we should actually be worried and that there was a risk of a 1970s scenario. And I said, if there's a war, remember this is a year ago, that's when you get inflation expectations really taking off. Well, we got the war in Ukraine, and we also have a risk of instability elsewhere, not least Taiwan, between the US and China. So the ingredients of the 1970s are already in place. The monetary and fiscal policy mistakes of last year, which set this inflation off, are very like the mistakes of the late 60s. And then, as in 1973, you get a war, except that this war is lasting much longer than the 1973 war, and so the energy shock that it's causing is actually going to be more sustained. So the question that I'm asking myself is, it looks a little bit like the 1970s, but are we sure it's not going to be worse than that? I mean, most people, when you have this conversation, kind of assume it can't be that bad, and they can't really envision double-digit inflation in the US, but we're already there with the UK. The number of countries with double-digit inflation in the world is already north of 40, and it will soon be a higher number than that. And so I ask myself, why shouldn't it be as bad as the 1970s? Why shouldn't it actually be worse? I mean, let's think about why it could be worse. Let's think about productivity growth. Looking at the supply side, that's actually worse than in the 1970s. Let's look at the level of debt. It's actually higher than in the 1970s. What about the demographics? They're clearly worse than in the 1970s. At least in the 1970s, you had détente between the superpowers. I don't see much détente between Washington and Beijing right now. In fact, I see the opposite. I see brinkmanship over Taiwan. So I'm going to go out on a limb. Last year I said we should be worried about the 1970s, and this year I'm going to say let's consider the possibility that the 2020...
So I think his final few words there that were cut off were we should consider whether it would be worse than the 1970s. So definitely could be. Stanley Druckenmiller, famous investor, has excellent returns over his career, warns that it could be a 66 to 82 type period. If you look back at that was a pretty horrible period. Sort of starts with the bubble in the Nifty 50, which sort of blows up in the early 70s. Then you have oil crisis, you have nasty recession in 1974, stock market gets cut in half. What else do you have going on? Watergate, sky-high oil prices, inflation kicking off. Takes all the way through the 70s into the early 80s, and Volcker raises the Fed funds rate to about 19% or something just to get inflation under control. And then, and by that time, PE multiples I think it's down to 8 or something like that in the United States on the S&P. So there's about 15 years of. I think if the market basically goes nowhere in 15 years, and if you add inflation, it went backwards during that period. What's not there is. I think Druckenmiller goes on to say in that article that he actually likes this. It gets. There are ways to make money in these periods, and he kind of relishes the challenge. I have to say, I do too. I prefer a period where we have a decent risk-free rate, so that not everybody's a genius because they bought anything and it all goes up.
Yeah, it'd be very nice.
What were you going to say about him?
Oh, yeah, he obviously has done. I don't think he's had a down year ever. So I think 1 year out of his whole investing period. Yeah. So he definitely pivots in and out
that's right.
at the best times. So if he's looking at it, you've got to be a little bit concerned.
Yeah.
I'm just, I'm just not sure about this inflation thing. I'm thinking, Russia's obviously playing a part, but Putin's not going to back down. you know, and he looks like he's doubling down at the moment, you know, trying to get all the reserves in, and no one in the West wants to speak to him to work out a negotiated, you know, end to this crap. So, you know, it's not a very good...
now there's talk of nukes.
Yeah. People would rather, you know, glass their children than speak to Putin. Like, it's just freaking nasty stuff, you know. So, who wants to, you know, this is terrible. Like, even if you don't like Putin, you know, you should be working to, you know, come to a solution to this instead of going, oh, we're just going to... Like, the CIA is just loving all this crap, you know. The longer they can drag this on, the worse they can... You know, they can, you know, keep Putin down,
we've all heard
Russia
about
down for another decade.
The CIA... Well, we've all heard about the CIA's exploits in Latin America and other places during the 70s and whatnot, and installing dictators or get rid of dictators. You know, now, and, you know, of course they've been rightly criticised for that, and I wouldn't mind a bit of CIA action in there now and get rid of a dictator. That'd be, if that was on the menu,
but they're pretty busy.
They can't do that stuff anymore.
No. Yeah.
But you'd have to be. I don't know. What's going on in the? Go ahead.
I just don't see inflation coming down, you know, to under 4%, you know, anytime soon. And, you know, so I think, you know, I know the balance sheet will roll off a little bit, and that's going to cause liquidity to dry up a little bit, but, you know, rates are going up, but they're still nowhere near going high enough, and the fuel crisis in Europe is out of control. So, I think Druckenmiller could be right here, you know, but we get peace in Europe, you know, things may improve a little bit, I think, quickly, but I don't know where it's coming from.
There's always that possibility. Someone, I know Putin gets taken out, Russia comes out and apologises to the world and says we're going to pay reparations to Ukraine, and everyone's happy and we all sing Kumbaya, and the stock market goes back to S&P 5,000, and it's happy days, but I'm not going to bet on that one. So I just wanted to bring some cheer to this doom and gloom and say that Ray Dalio's in Bridgewater, his Pure Alpha fund is up 25% this year, which I'm sure everybody listening is probably invested in, and so there's nothing to worry about then. But you know, one more macro item. You brought this to my attention. Consumer confidence is pretty low. It's near a pandemic low, and we haven't, as we discussed last week, we haven't really felt the full effects of interest rate rises, the petrol subsidy rolling off, and you know, just the macro headwinds that are facing Aussies. We haven't really felt the full effect of that, and consumer confidence is already in the toilet. But do you have any idea how correlated consumer confidence is with markets? I suppose you can see there it's pretty well correlated with the financial crisis that went into the toilet. Equities or just the economy in general?
Well, yeah. Well, the retail side, you know, meme stocks and all that stuff, yeah, that's all going to, you know, Tesla going to get people putting money in when, you know, there's consumer confidence is going down. You know, they're not going to be thinking about taking high risk on, you know, they're going to be obviously holding on to their cash, you know, trying to think, you know,
well, I think
am I going to have
Australia,
a job?
I think it's,
you know, you're not going to be thinking, I'm going to be a millionaire.
Yeah. I don't think retail sales has ever gone negative in Australia with the data that goes back to the 1980s. Now, I could be wrong what happened in the pandemic, but retail sales has never been negative, right? Because people have got to eat, you know. They just change the mix of goods and services that they consume, but you know, they've still got to eat. So they won't be, I don't know, splurging on that new quilt, but they will trade down for some hamburger mints. So anyway,
so it's just interesting to see.
Consumers not feeling great. And
there doesn't seem to be relief in sight. You know, that's the thing that got me a little bit concerned. You know, you can see that 80 is sort of at the bottom there, but you know, when there's no interest rate relief to put some more money back and make people more confident, how low will it go? Will you can get to a 50 handle, or we should flush out a lot of baristas. So I don't know, but we'll have to wait and see.
Yeah. Well, it's never been below. I mean, I don't know. I don't know how old that series is, but it's never been below about 75 there, and that was the nadir of that was the initial panic of the pandemic, wasn't it? In March of 2020.
Yeah.
We shall see. We might revisit those lows. So, FedEx reported last week. Shares fell 15%. Why do we care about FedEx? It's talked about as a bellwether stock. Is it a bellwether? Of course, it's a logistics company all over the world, so it's sending parcels to everybody all over the world. Is UPS and Amazon just eating their lunch? Because these guys, their volumes are way off compared to what they'd guided to. Now, is this stock specific, or is it actually signs of bigger things? Because right now in this environment, any CEO can blame a bad quarter on, it's the macro environment, right? That's the excuse du jour. Maybe it is, maybe it isn't. You have any insight into FedEx?
I know Amazon's eating their cake. Like, you should see the number of orders that Amazon's are doing. Like, they're like crossing over, like 50-50 now. So the amount of orders they're sending. So, I'd be a bit worried if you're at FedEx. You're thinking, well, what else can we do here? Like, how can you compete against Amazon? They don't need to earn money. They don't need to cash flow. They don't need it. So their investors are already hardened to take, no dividend, no nothing. So, I think it's a little bit, truthful, but I think he's trying to overblow it here a little bit. Because I think he's forward estimates 50% down what the market's expecting. So I think he's just trying to cover himself a little bit here. In a couple of months' time, he's going to look like a genius. Like, his forward estimates, he's above them, and everyone's doing great. So.
Yeah, well, that's the game. Guide low and over deliver. But it's been the game for a long time. I just include that last sentence there. FedEx vowed to cut costs aggressively and said it was mulling over other ways to enhance productivity, which means layoffs. They're going to fire some people. Surely, that's what's coming. That's how I read that.
So there was heaps of fat in currently, or they were running inefficiently now? Is that what he's admitting to? That he hasn't been running the business well? I
just interpret enhance. Don't know. I interpret enhance productivity as not very good or not very subtle code for we're going to lay off some people.
Yeah, but how do you deliver packages without workers? Like, I still haven't worked that out yet. He's
maybe you just
there or
stop.
Something.
Yeah, well, or maybe you just you stop delivering certain types of packages. Amazon's got that now. We're out of that. We'll stick to our knitting, whatever that is. Maybe this is just a dinosaur stock and needs to go away. We don't need FedEx anymore. Doesn't need to exist. Who knows? Don't know. Amazon's eating everything still.
Yep.
And that's just the FedEx chart. That's pretty awful, isn't it? And that was 3 or 4 days ago. So very ugly, very ugly. Now, you want to talk about? You brought up this value line safety rank because you're having a bit of a tough time trying to find things to buy during this.
Yeah, it seems
these times.
What has got value at the moment? Like, things are falling, so you're going, oh wow, should be looking. Should be starting to put in a tranche or two. You can't pick the bottom, so you should be looking at quality. You shouldn't be looking bottom fishing too much. So I came across this great article, or it's more of a journal article about how do you sort of value things and they tried to look at Value Line, which is a really, multiple decade old company who's been valuing stuff.
Yep.
And everyone assumes it just looks at low PE, old-fashioned, Graham type, value multiples. But as you can see here from a lot of the companies, they're not low PEs.
Yeah.
So there's a lot of factors going in. So you've got this safety rank. Yeah, they've got Adobe in there, which is still a high PE type company. So, you've got a safety rank, which is basically, solid balance sheet, good fundamentals, not going to go bankrupt.
Low debt.
Low debt, all that sort of stuff. Good cash flows, all that sort of stuff. But then you're like, well, there's a lot of companies like that, but they're overvalued. So you've got this timelessness rank. And so they've got this little chart down the bottom here where you pick the top 2 safety ranks, and then within the next 3 to 6 months, should there be a catalyst, to maybe increase that value. So so there's a lot of them there that are quite good value, and you see a lot of the top investors starting to get into a few of them as well. Like Apple, Google just looks, and Amazon, they still look like good value, really. If you're taking these 2 things into account, like, you've got to think long term here, but so at the moment I'm trying to pivot a little bit from being a cigar butt investor, trying to, pick off pennies in front of steamrollers and trying, nor falling knives. I've sort of been burnt by that a bit too many times. I see Alibaba's back under $90 again, so it's got me thinking, wow, I'll grab a bit more of that, but, I should be thinking about, there's other things on sale as well, like, Adobe and Google and Amazon still look like steals at this sort of price. But you're seeing MasterCard, I was looking at that this morning, thinking, wow, just solid companies.
MasterCard and Visa are just, it's just, it's a pretty solid business.
Yeah. So there's a couple there that I'm not too sure on. But,
So, you brought up that idea of falling for value traps, because you think, low PE. And I remember when I first started, I think this is back in the days before the internet, and you would get the Financial Review and on a Saturday or something, and it had a bit, it didn't just have the share price, it would have a few things like PE, and might have had PE to G even, and a few other things. And back then, I think I was in high school, or maybe the first year of university or something, I thought if it had a low PE, that means it was good value, and if it had a high PE, it was expensive, And you have to learn that lesson, that a stock on a PE of 8 can be more expensive than a stock on a PE of 30. That's possible, because the stock on a PE of 8 may have no growth in a declining industry, and the stock on a PE of 30 is increasing its earnings by 50% in a fast-growing industry. So you have to unlearn that one pretty quickly.
Yeah, I've probably still got some learning there to do. So got to burn a little bit more cash yet, I think, before I come to that realisation. But I think that's all part of the learning process. Yeah. But I'm trying to look at price to free cash flow now. I'm trying to move to that. Return on invested capital. So I'm trying to grow up a little bit. But it's just hard when you've been such a cheapskate your whole life, and you're thinking, I'll go and pick something that's good value. But I'll get over it. But I thought, others might see value in this. If you want I'm thinking about maybe even semi-releasing this every couple of months, doing analysis on this and putting the value line numbers together, just so people aren't fishing in junk like I normally do.
Infested waters.
Yes, and looking at numbers too much when you should be, looking at quality a little bit more. So that's all. Yeah, that's what I'm trying to do at the moment.
All right, so this is something you stumbled across. You want to take us through this company?
Yeah, so I'm running a few screeners, looking at what has value, and obviously I like a thing called return on invested capital.
Yep.
It's a really big metric for me. It sort of shows how strong a company is about investing their capital. Still doesn't mean everything.
Yep.
I think you can invest capital really well, but can you keep doing it over and over for many years? So
that's it, and at high rates of return, because there's a certain point where, sorry to interrupt, but there's a certain point where if the returns are, if your return on capital is 5%, then you're better off just paying it out as dividends. It's no point. You're better off rather than reinvest. If you can reinvest your returns at above 20%, and you can do that all day. That's when you're on a winner.
Yeah. So companies like MasterCard and Visa, obviously, especially MasterCard, are sort of the poster child. They can just invest in more infrastructure, and putting it out there, which doesn't cost them much. So every dollar they reinvest, and they can keep finding places to reinvest it. That's the cool thing about it. So over multiple years, their return on capital employed, or whatever, return on invested capital, are showing high double digits, which is more important than just a big spike. So I came across this, thinking, maybe a recession's coming on. Maybe the second-hand market might see an uptick finally.
What's this company called?
Winmark Corporation.
What's this?
Winmark Corporation. And basically it's a franchise-type model. So if you know how Domino's works, Domino's doesn't actually own any of the pizza places. You basically just pay a franchise fee to Domino's, and basically they just take a cut and do a bit of advertising for you. So it's very light, capital-wise. But so this company takes $25,000 and then takes 5% of your gross revenue. So basically, and they do a little bit of advertising, and then they, group buy a few new goods as well. So why is that interesting? Is because they have these crazy gross margins in the 90% and operating margins in the 50s, which is basically, I see meth dealers with worse numbers than these, So obviously it's either a fraud, there's obviously huge amounts of fraud going on here to get these sort of numbers, or
maybe
this is an out of the world.
Maybe your meth dealer, not mine.
Yeah, well, I don't know, but I'm sure Pablo Escobar's, looking at these numbers thinking, wow, I need to get out of the, the cocaine game and get into something a bit more decent, like second-hand goods.
Yeah.
I don't know what's going on here, but, obviously it's a capital light model, but I'm trying to look for these compounders.
Yep.
So if anybody else sees any of these compounders where they can just put a little bit of capital in, and these crazy gross margins and operating margins with high return on capital employed, obviously they're a great business. So if anybody sees any of them, let me know. That's all.
What do we think about the fact that? Of course not. What do we think about the operating margin, which, so in 2012, 13, 14, it's sort of low 50s, then it gets in the mid 50s, and most recent year 65. So you would expect some contraction back down towards the trend, wouldn't you, from that 65? Yeah.
Yeah. So obviously
they can wear that pretty easily.
Yeah, as you can see, they're just printing money. Every dollar they put in there, they're just printing more of it. They can handle a heap of pain here. So, if their operating margins went down to 30%, that'd still be a brilliant company. That'd be up there, Estee Lauder and things like that. Yeah. So, you don't normally see companies like this. And obviously, when you see them this good, you're thinking fraud. It's just red flags are just going all over the place. But, I don't know. Someone might have a better insight than me on it, but just thought these interesting companies that I'm coming across.
So the business is this franchise model is selling second-hand goods, isn't it? Which, of course, during the pandemic is great business when people couldn't get their hands on. Just look at what happened to second-hand car market, for example. So second-hand goods. So I suppose that, I guess a lot of that's been pulled forward. You know, if we think about, so second-hand goods market probably going to go and retreat if and when supply chains get up and running again, I suppose, or back to sort of semi-normal, whatever that means, or maybe they don't. Who knows?
But I'm thinking, like, if a recession happens, you know, people might be looking and they, you know, haven't got as much cash in their pocket, but they still want to buy some goods. You know, they may be looking at, you know, second-hand options as an option, but there will be a contraction, yes. So I'm not looking at those, you know, 20, 21 sort of numbers. I'm thinking they're outliers for sure. It's definitely going to contract back below the, you know, 18, 19 numbers for sure, and then that's going to, you know, because that compression there, that's going to affect the price. But then, you know, if you get that compression, and then you think, okay, well, then a recession hits, you know, it might rebound quite quickly. So this might be a, you know, a beta, you know, a huge, you know, volatile stock, you know, that might jump around a lot within 6 months. Get the numbers, but
interesting.
So,
that's a good find.
I don't know. Yeah. Anybody else sees any other finds like that?
Yeah, we can have a look at them. And you want to, so this is another one you've been looking at. Adobe, which is basically peaked out at near $700, has been cut more than in half, hasn't it? It's down about 60%.
Yep.
How old's this chart? So that was just about 3 or 4 days ago, wasn't it? Jeez. It's absolutely smashed.
I think it's still falling.
Still falling. And you like this one? You like this one?
Yeah. Like, it's like Terry Smith just got into it, so obviously, you know, I'm like, wow. And why I like it is because it's a compounder. They do really well acquiring. So they just acquired a company called Figma for $20 billion. I'm a little bit worried that they're a bit overpaid for it, but because 12 months ago it was only $10 billion, and then I looked up the numbers before that, and it was only 12 months before it was $1 billion. So it feels like that they've overpaid for it here, but you know, the internal rate of return is.
Yeah. So when did the transaction close on Figma? Was that earlier this year or was it last year?
No, it's only a couple of days ago, I think.
Oh, really?
So yeah. So that's, people don't like it. Obviously, thinking, you know, they've overpaid. Because you go, oh well, they could have got it for half that price 12 months ago. And Figma's been big for freaking at least 3 years. But it's just the pandemic. People have been able to go online and collaborate together. So, but, you know, thinking, who's been working at Adobe who's missed this, you know, and haven't been speaking to Figma for a buyout, you know, unless they've been holding out. But they've been bleeding cash like nothing, Figma. So you think, oh, if I was an early stage investor, but Series D, I think it was only worth $1 billion. Right. But currently they've got enough revenue, which is basically, you know, everything, about $500 million, I heard. So the multiple's only 40 times, but
40 times what? 40 times sales?
Yeah.
Or 40 Jesus. Yeah, that's well. Maybe this is a classic. Maybe this is a classic end of cycle, paid way over the odds for it, and down the track there'll be a write-off of some amount. You know, they'll take an what they used to call them abnormal items, extraordinary items, which is code for CEO mistakes. You know, and have to write some of it off.
If you end up as goodwill on the, on the balance sheet, it's like, oh, what's that goodwill thing? That's a huge number, isn't it? Oh, what could that be?
Yeah.
Oh, that's just, fuck ups from the past, So,
yeah. Well, sooner or later that comes. I mean, even Procter and Gamble had to write down Gillette a few years ago, if you remember, because they bought Gillette basically at the peak when Gillette had 70 to 80% of the men's shaving market. Now they've got, I think, maybe just less than half, or about half. Because you've got all these fly-by-night shaving companies just, they send you a
Dollar
shaving
Shave
kit
Club.
with free razors. Dollar Shave Club, yeah, exactly. So Procter & Gamble has
But even
right
the
billions
established
off that.
Schick and all those, they've all picked up their game, like there's all, so it's not as...
Yeah.
The moat's not as big as you think. A bit of plastic and a razor isn't as much a moat as
it's strange, isn't it? You think, why for so long have they... I mean, even you go into the supermarket today here in Australia, half the shaving products are Gillette still, like half the things on the shelf are Gillette, at least. But you just think, like, how did no one see that, this you could cut into their profits here?
But you can't, like, even I cut into their profits. How I do it, I just purchased from overseas. So my razors come from eBay, which is just basically Gillette from China, which they're trying to, grow that market over there, and they've got a lower priced product there, which is the same product, but people are just shipping them from over there to Australia and selling them. So they're undercutting the supermarkets. So they can't get these high margins. So people are just looking at, the past 10 years and thinking, that growth rate's just going to continue and they're going to dominate. But it's very hard to do in a global world. So, I don't know about it, especially when, Adobe, you're comparing it against other tech companies like Amazon, Microsoft and Google, which have clear moats, So my DCF is, still says it's got $100 downside, but I'm an old school type. So you take $100 off this,
What's your discount rate? What discount rate are you using these days?
15%, but so
15.
So like this is very old school type multiples, on things, So obviously I'm not, going in backing up the truck to this thing, So I think
big margin of safety. That's what you're.
Yes.
Yeah.
So Yep. So, I don't know. Like I think they look good, but I think people have got to be careful here. Like I think it's you're looking at these PE multiples and you think, as you see on the screen, it's got a 28, and you're thinking, okay, well, that's not too bad. But what happens if earnings halves? You still got to, that's a double of that. You're looking at 50s, and you're thinking, wow. I just looked up Alibaba this morning's multiple, and I'm like, far out, that's a 40 PE, and it's halved in price, because the earnings has fallen through the floor. So, that's all.
Yeah, well, you remember a stock. You look at a stock and you think it's down 80%. How much more can it go? Well, if it halves again, it's down 90%. It can happen. It happens to plenty. It happened a lot in the .com. It's a tough one to learn. All right. Well, do we have any more? We got anything else after that? I don't know. Do we, or are we done? I think we're done. I think that's it. That was it. Okay. Adobe was the end of it. Well. Anything else we'd like to say, Tim? Any last thoughts? Macro, stock specific? No, all good. All good.
Yeah.
Or we might wrap it there then. Thanks everybody for listening, all three of you, and we'll see you next time.